Welcome everybody, and in this lecture we'll discuss about Provident Fund. Now what is this Provident Fund? What is its importance? How it is useful to you as an employee or a businessman, and how income tax department will tax it and give exemption on it. All this we will learn in this lecture, and plus we'll do numerical problems too. So focus on everything whatever I am sharing. First thing, employee joined a job. He is getting salary. Very happy, getting salary, right? Now, after retirement, what will happen? He started thinking, Ayyo, what will happen after retirement? How will I survive? I'll not get salary, right? Then he asked the employer. Employer said, sorry boss, how can I help you? Then he asked government. Government said, how can I help? Then finally, government said, hey, we have to take care of everybody, so let us plan something. And then what government said, that every year or every month when the employee gets salary, a small portion of the salary the employee will contribute to his retirement benefit. Similarly, employer will also pay from his pocket a small portion to the employee's account, so that that money can be used for employees' retirement benefits. Again I am telling, who will contribute? Employee will pay something, employer will pay something. That money will be kept in a separate fund. That's why we used the word Provident Fund, for the retirement benefit of the employee. In that, some part he will get in monthly format like pension, and some part the employee may get lump sum. It all depends upon type of fund. Clear to all of you? Very good. Now this way what happened, post retirement life will become easy for that employee, and for that purpose this concept of Provident Fund is there. So here what happened, here employee contributed something, that means it will be deducted from employee's salary. Employer will contribute something, he will pay from his own pocket, right? And that will be kept in a proper fund. Now what happens, interest, that fund, it will not keep like that. They will invest that money into some shares, into some debentures, some corporate bonds, some government bonds. Like that, that money which is accumulated and kept in a fund is invested into shares, debentures, bonds, and so it will give some return also, right? Some returns will be there. That return may be interest, that return may be dividend. This way that fund will earn money, and it will pay some interest to the employee. So ultimately, four elements come out of this. One is employer's contribution. Second one, employee's contribution. Third one, interest on employer's contribution. And fourth one, interest on employee's contribution. These four elements, what are they? Employer's contribution, employee's contribution, interest on employer's contribution, interest on employee's contribution. These all will come. Now, first, before we understand about Provident Fund, the taxation aspect, we should understand how many types of Provident Funds are there. So, there are four types of Provident Funds. First one is Statutory Provident Fund. So, Statutory Provident Fund, here it is for the government employees, right? Now, this concept is becoming outdated. This type of fund was there in the past, but presently, slowly its importance, its value is decreasing, and it will be wiped out in future. But as of now, we have to study, it is there. Statutory Provident Fund, it is Provident Fund for government employees, as per the Provident Act, Fund Act 1925. Okay, simple as that. Come to the second one. Hey, first one is Statutory Provident Fund for government employees. Now second one is Public Provident Fund. Now I am not a government employee, neither I am working in any other company or any other college full time, right? So now people like me, how can we plan for our retirement benefits? For that, government said, hey, you open a provident fund account, that is public provident fund account. In that you only contribute, self contribute the money, and that money will become big, that can be used for your retirement benefit. So basically, in public provident fund, there is no employer contribution, because there is no contract of employment which is backing this provident fund. Public provident fund is for individuals to contribute for their self interest, right? So self employed professionals can contribute to public provident fund. Even salaried employees who have other provident funds can open this public provident fund account and contribute for their retirement benefit. And this is actually awesome, because it will give very good interest rate. The best part is no tax on it. Okay, next thing, public provident fund is for self contribution. Okay, anybody can do, right? Next thing, third one is recognized provident fund. Now this recognized provident fund, in simple language, is some fund for employees retirement benefit which is recognized by the Commissioner of Income Tax. Okay, if it is recognized by Commissioner of Income Tax, we call it as recognized provident fund. There is a law called as Employees Provident Fund and Miscellaneous Provisions Act 1952. There is a law called as Employees Provident Fund and Miscellaneous Provisions Act 1952. There is a law called as Employees Provident Fund and Miscellaneous Provisions Act 1952. Now to this Employees Provident Fund Miscellaneous Provisions Act 1952 creates a fund for employees retirement benefit. That's okay. And any other fund under this law or any other fund which is recognized by Commissioner of Income Tax, that becomes recognized provident fund. Here employer will contribute, employee will contribute, and interest is earned on that, and the big amount is created later on retirement or death. Retirement, it is given to employee. If employee retires, it is given to employee. If employee dies, it is given to their legal representatives. Same in all the above. Fourth one is unrecognized provident fund. Now unrecognized provident fund is also a provident fund, but the point is the Commissioner of Income Tax did not recognize it. So if any fund is there for the retirement benefit of employee which is not recognized by the Commissioner of Income Tax, we call it as unrecognized provident fund. Now let's play a small game. Hey, if I say statutory provident fund, you should remember fund for government employees. If I say public provident fund, for self contribution, whether you are an employee or self-employed, you can contribute on your own. No employer contribution here in public provident fund. Recognized provident fund is recognized by Commissioner of Income Tax, and unrecognized provident fund is not recognized by Commissioner of Income Tax. Till date not recognized. Okay, if suppose unrecognized provident fund is there, tomorrow it is recognized by the Commissioner of Income Tax, it becomes recognized provident fund. Okay, very good. Now how to tax, whether it is taxable, how much is exempted, all questions answered. Let's focus. Hey, I said 4 funds, right? Statutory provident fund, recognized provident fund, public provident fund, and last one is unrecognized provident fund. And in that we should remember employer will contribute, employee will contribute, interest is earned on it, right? And finally one more thing I'll add, that is the fund money will be withdrawn by the employee. From these four perspectives, from these four activities, how income tax department will react, right? If employer contributes, how will income tax department view it? Employees contribution, how they will watch? Interest on it, how income tax department will respond? And when the money is withdrawn from the fund, how income tax department will respond? This is what we will study in this part now. First, rather than talking about each action for all the funds, let us take one fund and discuss all actions and their reactions by income tax department. Chalo, first thing. Suppose we have statutory provident fund. In statutory provident fund, it is government employees fund, right? And government employees Damaji. No, after Modi ji, they are becoming Beta ji. They have to do lot of work, right? So anyhow, statutory provident fund, employer's contribution is fully exempt, not at all taxable. So if it is statutory provident fund, employer contributed something to the fund, that is government contributed, it is fully exempt. When employee contributes something, under section 80C, deduction is available. Under section 80C, deduction is available. Okay. So employer's contribution exempt. Employee's contribution 80C deduction. Interest on such contribution fully exempt. And when withdrawn by the employee, employee takes all the money back. At that time also no tax, fully exempt. So I spoke about statutory provident fund. You remember? Chalo, repeat with me. Employer's contribution fully exempt. Employee's contribution deduction under 80C. Interest on all that exempt. Withdrawal exempt. That's it. Similar to SPF, there is something called as public provident fund. Here, because it is self contribution, there is no employer, so no employer's contribution. But employee will contribute, right? 80C deduction he can claim. In public provident fund, employee contributes, the individual contributes, we can use the word employee, no problem here, but 80C deduction he can claim. Interest on public provident fund amounts, no taxation, fully exempt. And withdrawal also fully exempt. So I spoke about public provident fund. Employer don't contribute, only employee, the individual contributes, he will claim 80C deduction. And interest and withdrawal, interest accrued is also fully exempt, and total amount withdrawn is also fully exempt, not taxable. Clear? Come to the recognized provident fund. First two are very easy, right? The third one is little complicated. So recognized provident fund. What they say? They simply say that here up to 12% of salary is exempt. More than 12% is taxable. Suppose an employee's salary is 1 lakh rupees and employer pays 15% provident fund. Employer from his pocket pays 15%. So 15,000 employer paid to the account of the employee, to the fund in the name of employee. So up to 12,000, that is 1 lakh into 12% will be 12,000 exempt. And the extra 3,000 is there, na? 15,000 employer's contribution, 15% of salary minus up to 12% exempt, that is 12,000, balance 3,000 will be taxable in the hands of employee. Okay, this way you should understand about employer's contribution. Employee's contribution is same. You contribute and claim deduction under 80C. Employee contributes and he can claim deduction under 80C. Okay. Now, what is 80C? Salary chapter we are in. 80C we'll learn later on. So simply remember, when we take income from salary, income from house property, income from business and profession, income from capital gains, income from other sources. When we do the all these total, we get something called as gross total income. We get something called as what? Gross total income. From this gross total income, we can deduct the deductions under 80C to 80U. The government benefit, so that you invest, you grow, all that government things, and they give deduction under 80C to 80U. And then it comes to final taxable income. So here 80C is a deduction. When we get the gross total income, from that we will deduct. Okay, that's it. Now recognized provident fund. Employer's contribution up to 12% of salary exempt. More than that is taxable. Okay. Second point, employee's contribution deduction under 80C. Okay. Next thing, interest. Interest on the accumulated balance. That means employer contributed, employee contributed, employer contributed, employee contributed. It became big money, right? On that, interest is there. That interest up to 9.5% is exempt. Up to 9.5% is exempt. More than 9.5% is taxable. Okay, up to 9.5% is exempt. More than that is taxable. Now you may ask, sir, what is the actual rate which the interest employees are getting? Presently it is around 7 to 8%, in between that. So that's why interest will never be taxable in today's times. But many years back, in 1970s, 80s, the interest rate was 16%, 18%. So when it was 16%, 18%, anything more than 9.5% was taxable. At that time it was. Presently anyhow, we are not getting that much, so interest will not be taxable. So we spoke about recognized provident fund. What we remember? Employer's contribution up to 12% exempt. More than that, taxable. Employee's contribution, we can claim it as deduction. Whatever employee contributed, we can claim it as deduction under 80C section. Okay, from the gross total income we can deduct. And interest on employee's contribution, interest on contribution by employer and employee together, that up to 9.5% is exempt. More than that is taxable. Up to how much? 9.5% is exempt. More than that is taxable. Wonderful, very good. Now fourth thing, withdrawal. Now withdrawal is exempt actually, but subject to certain conditions. When you withdraw the money from recognized provident fund, it is exempt, what government says. But there are many ifs and buts which we will discuss after some time, in few minutes. Okay. Come to unrecognized provident fund now. Unrecognized provident fund is not recognized, so government income tax department ignores everything. Employer's contribution not taxable, ignored. Employee's contribution not taxable, ignored. Just for the time being it is ignored. Okay. Interest on employer-employee contribution, ignored. Are you able to understand? So employer contributed, ignored. Employee contributed, ignored, not taxed. Okay. Interest on that, ignored. But when withdrawn, when it is withdrawn, at that time the government will take action. And that how the action is taken, we'll discuss in the note 1. Okay. But before that, we'll just see what is salary. Hey, unrecognized provident fund is clear, right? In the question, if they give that employer contributed something, ignore it. Employee contributed, ignore. Interest accrued, ignore. Only when they say it is withdrawn, then we will tax it. Or if they say the amount from unrecognized provident fund is transferred to provident fund, they will say amount from unrecognized provident fund is transferred to recognized provident fund. At that time, note 1 will apply and we will see how tax is calculated or how income becomes taxable. Okay. Now first let's see salary. Salary is equal to simple, very simple, basic pay, DA retirement plus what I said, basic pay, DA retirement plus commission as a percentage of turnover. What I said, basic pay, DA retirement plus commission as a percentage of turnover. Basic pay, DA retirement plus commission as a percentage of turnover. Fixed commission don't take. DA not forming part of retirement don't take. Only DA forming part of retirement is taken. So what is salary definition? Hey, basic pay, DA retirement plus commission as a percentage of turnover. That's it. Come to the next story. Unrecognized provident fund. So we'll first now understand unrecognized provident fund. Then we'll talk about recognized provident fund conditions and all in detail. So let's talk about unrecognized provident fund. What we remember? Employer contributed, ignored. Employee contributed, ignored. Interest on that, ignored. But withdrawn, then what will happen? When withdrawn, all the amounts are divided into few parts. Like suppose employer's contribution. That data will be there, right? So employer's contribution is taxed under the head salary. Interest on employer's contribution. देखो, employer's contribution, interest on employer's contribution. These two items are taxed under the head salary. Now employee's contribution, it is his own contribution, right? So that's why it is not taxable. Employee's contribution not taxable. But interest on employee's contribution, taxed under income from other sources. Interest on employee's contribution taxed under income from other sources. Now, employer's contribution, interest on employer contribution taxed under salary. Why, sir? This is also interest, right? But it is coming from employer, right? Correct? It is on employer's money, right? That's why it is taxed under salary. Interest on employee's contribution, it is assumed that he has given some loan to somebody or he has deposited in some bonds, and generally interest is taxed under other sources. So interest on employee's contribution taxed under income from other sources. So we spoke about unrecognized provident fund. At the time of withdrawal, what we do? At the time of employer's contribution, it is ignored, not taxable. Employee's contribution at that time also ignored, not taxable. Interest when it is accrued to the fund, at that time also ignored, not taxed. But at the time of withdrawal from unrecognized provident fund, or at the time of transfer of funds from unrecognized provident fund to the recognized provident fund, employer's contribution and interest on employer's contribution taxed under salary. Employee's contribution ignored and interest on employee's contribution taxed under income from other sources. Clear? Very good. Now what shall we do with recognized provident fund? Generally what government says, that keep the money at least for 5 years. If the employee works for at least 5 years or keeps the money in the fund for 5 years, then the whole amount withdrawn will be fully exempt. Suppose in the recognized provident fund money is accumulated, and after accumulating money, employee retired, and 5 years he did not do anything with the money, and after 5 years, in the 5th year, 7th year, 10th year, he withdrawn, then it is fully exempt. Now I can tell you more things in practical life. What happens? Suppose I worked in the year 2010 for 1 year in a company. Then that money 11-12 I worked, that money 12-13 I worked, that money for 10-11 year, 2 years over. For 11-12 year, only 1 year over. 12-13 year continuing. So are you able to understand? It is overlapping like that. For every year's contribution, separately 5 years will be checked. Okay? And if you withdraw the money after 5 years, right, then definitely it is fully exempt. Okay, you keep the money in the account for 5 years, after that you withdraw, fully exempt. We are talking about recognized provident fund. Okay, now if suppose it is withdrawn within 5 years, then what to do? We have to first understand what is the reason that you withdrawn the money within 5 years. Suppose you are shifting the job from one company to another company, right? You are shifting from Tata, suppose Tata Steel, you are shifting to something called as you are shifting to Reliance Petroleum. You are shifting. Now Tata also has Provident Fund account and Reliance also has Provident Fund account. And what happened when you shifted from Tata to Reliance? Your Provident Fund balance was shifted to the new company, that is Reliance. So in this case, if you have withdrawn the money within 5 years also, because it is just transfer of funds from one employer to another employer, it is not taxable at all. Okay, so if you are shifting the job from one employer to another employer and both the employers have provident fund account and your fund balance is shifted from old employer's account to new employer's account, then it is not at all taxable, even in case it is within 5 years period. Okay, now sometimes what happens, you shift the money from provident fund account to new pension scheme account, NPS. NPS, that is mentioned under section 80 CCD. Now what is 80 CCD we'll discuss when the chapter comes. As of now, in simple language we can say provident fund, recognized provident fund, is an old model of retirement benefit and new pension scheme is a new model of retirement benefit. Everybody believes that new pension scheme gives more opportunity to grow your money and safeguard your retirement benefits. Okay, that's in simple language. So you had money in your recognized provident fund account, so you shifted all that money to new pension scheme which is mentioned under 80 CCD. So employer, okay, income tax department says no problem, so fully exempt. Clear to all of you? If you withdraw the money after 5 years of service, right, after keeping the money in the account for 5 years, then also not taxable. If you withdraw within 5 years but it is transferred to new employer where recognized provident fund is maintained, then also not taxable. Another case is, suppose if you transfer from recognized provident fund money to new pension scheme account, then also fully exempt. If suppose you withdraw not because of the above three reasons but because you are severely ill and your medical treatment is required, for that you withdrawn, अरे मरने के बाद पैसे का क्या करोगे भाई, right? So what happened, you withdrawn the money because of illness, right, for medical treatment, then also it is fully exempt. Are company itself is closed, so you have no choice except to withdraw the money, right? So then also it is not taxable. Suppose you withdraw the money because of certain reasons which are not in your control at all. Like example, during COVID times the money was withdrawn, government allowed that employees can withdraw the money from provident fund. So these are beyond control, right? COVID is not in my control or your control, in Chinese control, Chinese virus, right? So what we discussed, I'm really seriously I'll tell, because China has given COVID to the world, every product of China, in short run or in the long run should be boycotted, and I am dead in seriously in support of it. Whatever the loss it may be, I have to compromise with means, okay, but I'll boycott. There are certain things which I have to take from China and nobody in the world creates. Definitely governments are working on it to create on its own. Right? With this we completed this understanding. In all these cases, like 5 years service, 5 years the funds were in the account and after that you are withdrawing, or within 5 years you are withdrawing but you are shifting to new organization and that organization also have provident fund account. Third one, you are shifting your recognized provident fund money to NPS account which is mentioned under 80CCD. Fourth one, because of your illness, because company closed, because of reasons beyond your control like COVID, you withdrawn the money. In that case also the money is fully exempt. The withdrawal from recognized provident fund is exempt. But what about in other situations not covered by these cases? Then the withdrawal will be taxable same like unrecognized provident fund. Same like unrecognized provident fund. Same like unrecognized provident fund. That means when you withdraw from recognized provident fund and it is not exempt, then employer's contribution and interest on it taxed under salary, interest on employees contribution taxed under other sources, employees contribution normally ignored. Okay, that's it. But there are some more things to study. क्या करेंगे हम, पढ़ेंगे और क्या. If suppose you are contributing to the NPS, new pension scheme under 80CCD, your employer is also contributing. So employer's contribution to new pension scheme is taxable. Employer's contribution to new pension scheme is taxable under salary. And okay, employer's contribution to new pension scheme is taxable under the head salary, but we can claim deduction under 80CCD. अरे यार, एक हाथ से देते हो दूसरे हाथ से लेते हो, क्या करे, कुछ नहीं कर सकते. So new pension scheme, when you contribute, when the employer contributes, it is taxable under the head salary and 80 deduction under 80CCD can be claimed. Done. Now very important but critical things to discuss. There are three ways in which employer can contribute to employees' retirement benefit. One is recognized provident fund. Second one is NPS, which we discussed, new version, new pension scheme, correct? Third one is superannuation fund. These some companies follow. Okay, what are the three I said? One is recognized provident fund. Second one is one is recognized provident fund. Second one is new pension scheme. Third one is superannuation fund. In all these three cases, what I said, recognized provident fund, superannuation fund, new pension scheme, in all these three cases together, in a year, in all these three funds together, in a year, if the employer contributes more than 7,50,000, suppose let's take the richest person in India is anyhow Adani, Ambani only, right? They don't take much salary because they want to grow their wealth through shares. But anyhow, if suppose Ambani is getting a salary of suppose 1 crore rupees per annum, very less, right? Even his employees may be getting. Anyhow, so 1 crore rupees he is getting, for simple example, and contribution to provident fund is just 12%. So what will happen? So you remember 1 crore into 12% is 12 lakhs, correct? So as per the recognized provident fund, what we discussed, up to 12% is exempt. Ambani ke to balle balle 12 lakhs not taxable. But this section comes here, this part comes and tortures Ambani. It says, hey, it may be exempt there, but it is taxable here. Up to 7,50,000 exempt, but that extra 4,50,000 is there, na? अब आपको 4,50,000 कहाँ से आए ये भी बताना, चलो बताता हूँ, टेंशन मत लो यार. 1 crore into 12%, how much? 12 lakhs minus 7,50,000 which is exempt. When we deduct it, you will get 4,50,000. That 4,50,000 is taxable, I said. Clear? Now suppose Ambani is getting 1 crore salary and 12% contribution to Provident Fund, and to NPS again 10% is contributed of the salary, and superannuation also something around 3 lakhs is contributed. So what happened here? 12% of Provident Fund, 12 lakhs, 10% of NPS, 1 crore into 10%, 10 lakhs, and superannuation fund 3 lakhs. So 12 plus 10 plus 3, 25 lakhs, right? And the first two are totally exempt as per the normal provisions. But income tax department said, okay, these three together, 12 plus 10 plus 3, 25 lakhs minus 7,50,000. Okay, how much will be there? Balance will be taxable. So 25 lakhs minus 7,50,000, how much it will come? 17 lakhs 50,000 will be taxable. This way you should remember. Point number 2 is clear? Yes or no? Every year we have to check this. So that normal exemption up to 12% of recognized provident fund is exempt. But we should check there and give exemption there. But again we should check here and give exemption or tax as the case may be. Ha, sir, itna. Chalo, third point is also there. Let's see that. What is the third point talking about? Not only the amount above 7,50,000 is taxable. Contribution by employer. Here we are not at all talking about employee. Contribution by employer up to 7,50,000 exempt. More than that is taxable. It's not over. There is something called as interest also. So any interest or dividend on the contribution by employer above 7,50,000 will also be taxable. So in simple language, if Ambani's salary is 1 crore rupees, 12% is the provident fund, so it will come to 12 lakhs rupees. So 7,50,000 exempt, 4,50,000 taxable. We discussed, yes or no? Very good. Now what they are telling in point number 3, that interest on these 4,50,000 is also taxable. Right? Sir, what about interest on that 7,50,000? Arey yaar, if the interest rate is less than 9.5%, it is exempt. Okay? But if the contribution is more than 7,50,000, even if the interest rate is less than 9.5, that interest will become taxable, but only for that portion of the contribution which is more than 7,50,000. Okay? So whenever employer contributes, he will divide into different accounts. Up to 7,50,000 one account, more than that into one account, because up to 7,50,000 exemption can be claimed for the contribution and on that interest also. But if it is more than 7,50,000, that is kept in a separate account, because not only the contribution is taxable, but interest on that is also taxable. Done? So this way we should understand point number 3. Shall we go to इतना ही कर दिया होता तो बस होता मेरे दोस्त? But government is very interested, clearly focused, that अमीरों से लूंगा और गरीबों को दूंगा. So employers' contribution, which people were enjoying from so many years, huge amounts of contributions they were getting from employers and enjoying exemptions, now they limited. Okay, you are lower class people, middle class people in financial terms only. Okay, government is ready to support you, give exemption. But if you are rich, your duty to contribute to the nation arises. More responsibility arises. So government taxed the contributions above a particular limit which we discussed. But till now we just discussed about employers' contribution. But what happened? We should also think about employees' contribution, right? If employee contributes more amount and income tax department gives more exemption, is it right? The answer is yes. If employee contributes more amount from his salary, okay yaar, will not tax it, no problem. But interest on that more amount should be taxed, correct? Because employees contribution yaar, salary is anyhow taxable. So from that salary only employee is contributing. So that's why employees contribution not taxed. But interest on that is taxable. So here only three items we'll read: statutory provident fund, public provident fund, recognized provident fund. Okay, again, statutory provident fund, recognized provident fund, public provident fund. In these funds, if the employee contributes up to 2,50,000 in a year, up to how much? 2,50,000 in a year, all normal rules will apply. Okay, I am only talking about interest. Okay, contribution is the point on which interest should be calculated. That's why we are talking about contribution. So contribution up to 2,50,000 normal rules will apply. But if contribution goes beyond 2,50,000, then suppose 4 lakhs contribution done. So entire 4 lakhs contribution is exempt, no problem. But it is divided into two accounts. Up to 2,50,000 keep in separate account. More than 2,50,000, that is extra 1,50,000, keep in separate account. Because interest on that 1,50,000 will be taxable. Interest on that 1,50,000 is taxable. So employees contribution above 2,50,000 we will check, and that extra contribution we will see on that how much interest is earned, that will be taxable. But when this started? 1st April 2021. When it started? 1st April 2021. When it started? 1st April 2021. Sir, if suppose in the past also employee contributed more than 2,50,000, now on that portions also we will now calculate interest, and on that excess portion that interest will be taxable. Hey, before 1st April 2021, whatever contribution was there by employee, whatever accumulated balance is there, the interest will be exempt like earlier only. Any contribution after 1st April 2021 is there, na? On that we will see, is it up to 2,50,000? No problem, we'll keep in fund, ignore. More than 2,50,000, that extra is kept separately. On that, whatever interest is there, only the interest portion is taxable. And this accumulates every year. So every year when you actually contribute as an employee, up to 2,50,000 will go in one part, one record, and more than 2,50,000 will go in another record of the fund. And that another record related extra fund is there, na? On that interest portion is taxable. Whatever about first step, whatever about before 1st April 2021, before 1st April 2021, whatever contributions were there, that will be exempt even after 2021. It was exempt before that, now we will charge interest. No, 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 no. It was exempt before 2021, 1st April 2021, and after 1st April 2021 also, interest on that part will be exempt, not taxable. Only on contributions after 1st April 2021, We are checking, divide into two parts, and above 2,50,000 whatever contribution is there, only on that portion interests are taxable. Like this we should understand each and every topic. It was heavy, right? Read it for 1-2 times, you will definitely enjoy it. Any doubts are there, you can always contact me, I'll be very happy to help you. Okay, we'll solve some problems to boost our confidence. Now see this question. Mr. X has the following salary structure. They simply gave basic pay 10,000 and dearness allowance as 1,000 rupees. X contributes rupees to 20,000, right? Rupees 20,000 to Provident Fund. Employer also makes a matching contribution. Yani employee made 20,000 contribution, so employer also made 20,000 contribution. Now compute gross salary if in the three cases they gave A, B, C. First case they said that it is a government employee and statutory provident fund. Second case it is a recognized provident fund, and third case it is unrecognized provident fund. Now what they want us to do, they asked us that we have to actually 1 minute, yeah, compute gross salary they asked. So what is the question? They gave you basic salary 10,000, they gave you DA to be 1,000. Hey, I forgot, commission also given, right? Commission is fixed 2,000, and they gave entertainment allowance to be 2,000, and your contribution to provident fund 20,000 by employee, by employer, both. And finally, if three different types of funds are there, how the treatment should be, we have to practice. Let's start. So we have to compute gross salary, right? So same we will do. Recognize the provident fund will just be an adjustment. Okay, chalo, write down computation of computation of taxable salary of computation of taxable salary of Mr. X. Mr. X for the assessment year 23-24. For the assessment year 23-24. Write down case A, case B, case C. Case A, case B, case C. In each case there is details and amount. In each case there is details and amount. In each case details and amount. So particulars, case A details amount, case B details amount, case C details amount. Now we are computing gross salary. Okay, so we'll do super fast, as early as possible we should try to close. So we have basic pay 10,000 per month, right? So into 12 months it would be 1,20,000. So we have to write basic pay 1,20,000 we should write in all the three cases, correct? Case A 1,20,000, case B 1,20,000, and case C also 1,20,000. Now like this basic pay only, there is a word called as commission. So we'll first complete that part. Commission, it is 2,000 in all the three cases. So let's write down commission 2,000 in all the three amounts column. Case A amount column 2,000, case B amount column 2,000, case C also amount column 2,000 rupees. Now basics of salary is over. So now we have to write allowances. Right? We have dearness allowance, we have entertainment allowance. So first we'll write allowances as heading. Okay. In that, let us write down first dearness allowance. In details, we'll write, hey, it is 1000 per month, right? So yearly how much? 12,000. So in case A details 12,000, case B details 12,000, case C details 12,000. Everybody wrote dearness allowance. Now we should write entertainment allowance 2000 per month. So 2000 per month entertainment allowance, how much it will come to? 24,000. Entertainment allowance 2000 per month, it will come to 24,000. Right? In details we'll write case A 24, case B 24, case C also 24,000 we'll write. Right? Now let's go to the total. We have to do the total of allowances. So allowances 12,000 is given as dearness allowance and 24,000 is entertainment allowance. We know dearness allowance is fully taxable. We know entertainment allowance is fully taxable. So total how much? 12 plus 24, 36,000. So let us write down 36,000 in amount column. Case A amount column 36,000. Case B 36,000 and case C amount column also 36,000 we'll write. Okay. Very good. Now we covered, I feel, everything. Let's see. I see basic pay is over, commission is over, entertainment is over, and DA is also over. Okay, so I feel everything is over. We have only provident fund, that is 20,000 by employee and 20,000 by employer. So now write down that employee will claim it as deduction under ATC. So employee's part will ignore, because they asked us to find out gross salary. Correct? So we have to only write employer's contribution. Employee's contribution under ATC, it will come after gross salary. But employers is taxable, right? So let's write down employer's contribution to PF. Employer's contribution to PF. So now case A, we should be very careful. It is statutory provident fund. Correct? Case A is government employees statutory provident fund. Case B recognized provident fund. Case C unrecognized provident fund. Okay? So case A 20,000 will write because employer contributed 20,000. And if you remember, we discussed that statutory provident fund total amount is exempt. Correct? So write down less exempted. How much? Total 20,000. So 20 minus 20 will be nil. 20 minus 20 will be nil. And this we did for statutory provident fund only. Okay, done. Now we have to calculate for recognized provident fund. But in recognized provident fund, what is the rule? Rule is 12% of salary is exempt. More than that is taxable. But 12% of salary means what? Salary means basic pay plus DA, retirement plus commission as a percentage of turnover. So here commission is fixed, will not take it. Basic pay is 1,20,000 and DA is 12,000. So 32,000, 1 lakh 20 plus 12,000. So 1 lakh 32,000 will be there. On that 12% is exempt and balance is taxable. Rather than orally doing, shall we put it on paper? You would be happy, right? Chalo, let's start. Contribution to recognized provident fund. Contribution to recognized provident fund is exempt up to 12% of salary. Is exempt up to 12% of salary. Salary for such purpose क्या है? Particular amount will write. Okay. You know basic salary is 1,20,000. So we'll write that. Commission fixed. So we'll not take it. So we'll write nil. Basic salary 1,20,000. Commission fixed nil. And last one, dearness allowance. How much? 12,000 rupees. Dearness allowance 12,000 rupees. How much it will come to? 1,20,000 plus 12,000. It will come to 1,32,000. 1,32,000. Now you use calculator 1,32,000, correct, into 12% is equal to 15,840 will be exempt. How much? 15,840. So let's come to the main solution now. Okay, everybody, come to the main solution. In provident fund, recognized provident fund, case B, we will write 20,000 in the details column. Correct? From that, exempted portion is 12% and 12% came to 15,840. So exempted will write 15,840. So from 20,000, if you reduce 15,840, it will come to 4,160 rupees. 4,160 rupees. Correct? Very good. Now come to the last part. They gave case C, unrecognized provident fund. And you know in unrecognized provident fund everything is ignored. Provident fund contribution at the time of contribution is not taxed. At the time of withdrawal it is taxed. But here it is not the case of withdrawal, right? It is the case of contribution. So it is ignored. So write down 20,000 in the fund column and exempted also 20,000 and we'll write nil. Why we did this? Because we want to ignore. That's it. Okay. Now we have all the amounts, everything done. Just do the total to get gross salary. So write down gross salary. In case A, 1,20,000 basic pay, commission 2,000, 1,22,000 plus 36,000. So 1,38,000 will come, I feel. How much? 1,22,000 plus 36, right? 32, 42, 52, 58. Yeah, 1,58,000 should be your gross salary. 1,58,000 should be your gross salary. Case B, let us see. Again 1,20,000 plus 2,000 plus 36,000 plus 4,100. So obviously it will be 1,62,000 160. 1,62,160. Right? Very good. Case C, let us do now. Case C again same, 1,20,000 plus 2 plus 36. So 1,58,000 only it will be. Hopefully you understood what I tried to convey. Done? Now let us write down one more note. The solution is done. This way we should solve any problem. One more point. Contribution to, let's write down. Contribution to statutory. We discussed it, right? Statutory is exempt, unrecognized is exempt. Same thing we'll write. Contribution to statutory and unrecognized provident fund is fully exempt. Contribution to statutory and unrecognized provident fund is fully exempt. Is fully exempt. So this way we should solve the problem. Now one small thing which I actually missed out in the notes. What happens is, if suppose URPF is there, unrecognized provident fund, and it is converted to recognized provident fund. Unrecognized provident fund is converted to recognized provident fund. It is deemed that the accumulated balance in URPF was taxed as if it is recognized provident fund. So URPF, whenever it is converted to recognized provident fund, it is deemed that the balance is recognized provident fund, the accumulated balance is recognized provident fund, and its taxable income is calculated like recognized provident fund, up to 12% of the contribution exempt. Now I'll tell you, if suppose you withdraw the money directly from URPF, employer's contribution is fully taxable under a salary, interest on it also taxed under salary, and interest on employee's contribution taxed under other sources if you withdraw the money from URPF. But if URPF is converted to RPF, in that case there is a special benefit given that the taxation will be considering it is RPF only. Now suppose a company has created a fund, it applied for income tax department for exemption, it took some time to claim the exemption, so it is not their mistake, correct? So that's why these type of facilities are given. Now let's start with the question. So don't worry, suppose that fund was URPF for last 3 years and in the current year itself it is converted to RPF, then all that 3 years income, whatever is accumulated, that will be taxed in the current year when it became recognized, right? But it will be taxed not like URPF but like RPF. Okay, that means each year's taxable portion is separately calculated and the taxable amount is totaled and taxed in the current previous year when it is recognized as RPF. Let's start. Mr. Sharma has been appointed as an accountant of ABC Limited as on 1st April 2020. Since then he is working with the same company. The salary structure and increment details are as under. Salary structure and increment details. When you see the pro forma, it is something like a grade pay. That means basic salary, first year you will get 5,000, second year you will get 6,000, 5,000 plus 1. Okay, 5,000 plus 1,000, 6,000. Third year you will get 6,000 plus 1, 7,000. Right, fourth year you will get 7,000 plus 1,000, 8,000. Fifth year you will get 8,000 plus 1,500. Like that the grade pay operates. Same way with DA also. First year 3000, second year 3500, third year it is 4000, something like that. He and his employer contributed to URPF 14% of basic and DA. So 14% they contributed, 12% exempt and 2% taxable. Every year 9% interest is credited. Now 9% is credited, but up to 9.5 it is exempt, correct? Up to 9.5 it is exempt, right? Hmm. Interest is credited to such fund as on 1st April 2022. So 1st April 2020 the URPF was there, but after 2 years, that is 1st April 2022, the fund gets recognition. Hence the accumulated balance in URPF was transferred to RPF. Comment on tax treatment of such transferred balance. So transferred balance, how should we tax? We should calculate. Write down everybody. Statement showing treatment of transferred balance statement showing treatment of transferred balance. So let us draw the pro forma. We'll first write year, then we'll write employer's contribution to the fund, then we'll write exempted amount contributed, okay, exempted amount considering the fund is RPF, and last one is difference, that is taxable amount actually. Now in 2020 1st April actually the fund is created, right? URPF is created, right? For that year we will calculate first. So write down in the year 2020-21, 2020-2021. Okay. Now you tell me, if his salary, basic salary is 5000 in the first year, 5000 per month in the first year. So yearly how much basic salary? 5000 into 12, 60,000. And his DA is 3000 in the first year per month. So how much it would be? 3000 per month into 12, 36,000. So basic pay 60, DA 36, and for this 14% contribution, right? Same thing we'll write. 14% of bracket open 60,000 plus 36,000. 60,000 plus 36,000 bracket close. That is how much it will come to? 60 plus 36 will be 70, 80, 96,000 into 14% we should do. 96,000 into 14%. It will come to 13,440. It will come to 13,440. Okay. Same, how much is exempt now? This is taxable portion, but something should be reduced as exemption, right? And that is 12%. So write down 12% of. Now we can directly attack, right? 60 plus 36 will be 96,000. So 12% of 96,000. That is rupees 11,520. Yes. अरे यार 96,000 into 12%, you write on calculator, you will get 11,520. Now what you should do? You should deduct from 13,440, from 13,440 minus 11,520. You will get the difference, that is taxable portion, and it is 1920. And it is 1920. And it is 1920. Done? Very good. Now 2020-21 is done. But 21-22 also we should do, correct? So write down 2021-22. Now is it same 60,000? No. Because basic salary was 5,000 per month. It increased by 1,000. So it will become 6,000. And DA was 3,500. Oh sorry, 3,000. And 500 increment. So 3,500. So 6,000 into 12 will become 72,000. Basic salary per annum is 72,000. And DA 3,500 into 12 will be 42,000. Correct? And we should calculate the taxable portion, exempt portion and all that. So write down 14% of, bracket open, 72,000 plus 42,000. 72,000 plus 42,000. How much it will come to? 72 plus 42. How much it would be? 70 plus 40, 1,14,000 I feel. Yeah, 1,14,000. 14% into 1,14,000 when you do, it will come to 15,960. It will come to 15,960. Done? 15,960. Now what is exempt? Only 12%, correct? So same, exempted we'll write now. 12% of 1,14,000. 12% of 1,14,000. That is 13,680. 13,680. Now your amount which is taxable is 15,960. 15,960. From that you deduct exempted portion, that is 13,680. Correct? What is taxable portion? The difference 2,280. And from last 2 years, because it was URPF, you did not pay tax on that. But this year you should pay, right? So for that we will do the total. So 1,920 plus 2,280. When you do the total, 4,200 will come. The total will be 4,200. Now let's go to the next part. Now whatever relating to 2020, 21, 21, 22 we did, but for 22, 23 we also should do, right? So let's do that now. Current year, that is 2020-23. Current year, that is 2020-23. Contribution shall be treated as RPF. Treated as RPF. and taxable amount will be, now we don't know how much, so I'll just not write anything. Taxable amount will be, I'll just leave some 1 2 words we should write. For that we'll leave space and write bracket open being. Now we have 14%, correct? So write down being 14 minus 12%. So here we are doing directly because only 2% is taxable, right? That's why 14 minus 12% of again bracket open. Now tell me, it was 5,000 basic pay in 2020-21. It became 6,000 in 21-22. It will become 7,000 in 22-23, right? So 7,000 into 12, 84,000. So bracket open, rupees 84,000 plus DA also. It was 3,000 first. 2020-21 3,000. 21-22 500 increment, so 3,500. So 22-23 it should be 4,000, correct? 500 again increment. So 4,000 into 12, 48,000 will be there. So write down plus 48,000. Bracket close. Now tell me, 84,000 plus 48,000, how much it would be? 92, 102, 12, 22, 32. 1,32,000 it is, right? And 1,32,000 into 2%. How much it will come to? That is 2% of, write down, that is 2% of 1,32,000. 2% of 1,32,000. How much it will come to? We left some space to write, correct? Will be, right? Taxable amount will be rupees, how much? Are 1,32,000 into 2% you do, will be 2,640. Will be 2,640. And all of us know one thing, 2,640. Done? Interest is exempt, yes or no? Up to 9.5% it is exempt. Here we are paying only 9%, so fully exempt. Same thing we'll write. Since interest rate is less than, the exempted limit, less than the exempted limit, that is 9%. Hence, interest portion is not taxable. Hence, interest portion is not taxable. Now, देखो, we have 4,200 and we have 2,640. When you, this 4,200 also taxable in 22-23, 2,640 also taxable in 2020-23. So totally it will become 6,840, correct? So same thing we have to write. Chalo, total taxable salary, write down total taxable salary on account of provident fund. On account of provident fund for the assessment year 2023-24, for the assessment year 2023-24 is rupees 6,840. 6,840. How did we get this? So that also we'll write. Bracket open being 4,200 plus 2,640, being 4,200 plus 2,640. This way we should solve the problems. Okay, very good. And with this we'll conclude this lecture. In the next lecture we'll meet. Take care. Bye bye everybody.